fiscal year from the Reserve Bank, giving little relief to banks by paying them more for their idle cash. It raised their reverse repo rate but left the key policy rate, which is the repo rate, unchanged. It's also raised its alarm on inflation, saying that there are a few disinflationary events. Lata Venkatesh and Ritu Singh get you the highlights of the RBI policy.
It was more like a relief policy. Markets were worried that Governor Patel may suck out the excess liquidity through a raise in the CRR, or the cash reserve ratio. They were spared that horror. Instead, they got a lollipop. The RBI said it will not pay 5.75% but 6% for all the idle cash that banks park with the RBI in the reverse repo window.
The objective is to more finely align the money market rates with the policy rate, bring down volatility and create conditions for improved transmission of monetary policy across the whole spectrum of interest rate.
In addition, the RBI hinted it is working along with the government for a new tool to drain liquidity, the standing deposit facility. Currently, when RBI absorbs money from banks via reverse repo, it has to give them government bonds as collateral. The standing deposit facility, when allowed by law, will permit it to absorb money without any collateral.
The learning experience through the demonetization period and the constraints circumscribing instruments such as the MSS underscores the priority warranted for strengthening the instrument toolkit of the RBI. It is in this context that the RBI has proposed the institution of the standing deposit facility, drawing upon international best practices and the recommendation of the expert committee. We have been engaging with the government on this subject for some time and will continue to pursue the matter with them.
While the lack of a CRR hike was bond positive, the relief ended there. The RBI delivered a strong warning that it does not see any disinflationary bullets that will help it go towards the 4% goal. In fact, it raised its inflation forecast for the first half to 4.5% from its earlier forecast to 4 to 4.5% and to 5% for the second half from the 4.5 to 5% earlier.
What RBI is signaling is that the move to 4% is going to be challenging. There are no lucky disinflationary forces in the horizon that were there in the past. It is cautioning you that inflation is elevated relative to where we want it to be.
RBI also reiterated its GVA growth forecast of 7.4% for the current fiscal, with risks evenly balanced. Remonetization, a global economic recovery, and the government's focus on capital expenditure are expected to boost growth. On the big bad loan problem, the RBI did not announce any new measures, despite the widespread expectations. The central bank hinted it may tweak some rules governing default loans, but won't provide any easy terms to provide for defaults.
We reiterate that further creeping forbearance in the treatment of bank losses is untenable and costly for the rest of the economy.
I think there is a clear acknowledgement and recognition that the asset quality situation in which we are, there is no one size fits all. There would be case-specific instruments which would be required to be deployed, and a number of them were introduced by the RBI from time to time. So how to bring the faster implementation of JLF decision, how to enhance the number or role of oversight committees, or whether to look at the sectoral or size-specific approaches in achieving this resolution. These are all the options which are being considered and which are under active discussion.
The RBI also allowed banks to invest up to 20% of their net owned funds in real estate and infrastructure investment trusts. And the final guidelines on those are expected by the end of next month.
All told, a Goldilocks policy from the Reserve Bank on liquidity, allowing banks some relief by giving them a little more money for their idle cash, raising the reverse repo, collapsing the gap between repo and reverse repo, which is a good international practice. Secondly, on inflation, just putting the nation on notice that there are some signs that we should worry about, but no fears that there is a rate hike, any 2 or 3 policies down the line. And finally, on NPAs, making it clear that some tweaks may come, but don't expect too much forbearance. That's bad banking and bad regulation. Finally, a strong statement from the central bank against farm loan waivers and the deleterious impact they will have on both the banking system and on the borrowers themselves. From the Reserve Bank headquarters, Lata Venkatesh.